Good afternoon and welcome to our webinar for November. I'd like to begin by just talking a little bit about October month. October month is a very uncomfortable month for investors generally worldwide because it is the month in which the 1929 crash commenced and also the 1987 crash, and a number of other bad downward trends have occurred in October over the years. So investors are usually a little afraid of October month, and that fear translates into a bit of selling, which makes that October month to an extent self-fulfilling. The negativity is self-fulfilling. And obviously what you've got on the screen right now is the S&P 500, and you can see that starting from about the 3rd of October, you can see what the S&P 500 has done. It's gone down 9.5% at this bottom point, but now seems to be tracking up and moving back into the bull trend. Obviously, overseas investors are very aware of the fact that the S&P 500 has been in a bull trend for over 9 years, and as a result they think it's mature and the bull trend must turn into a bear trend and so on. That differs very strongly from our perception. Our perception is that this bull trend is really only just getting going, and you may recall that last month we said any correction is a buying opportunity. Obviously also the JSE overall index has followed the S&P 500 down, so we'll just take a look at that, and it's actually fallen 15% since the end of August, and obviously to some extent following the S&P 500, and there you can see it there, and the impact of the downward trend. A lot of that, of course, is due to the fall of Naspers and also Richemont, which are both really overseas shares. They're not South African shares really, although they're listed on the JSE. They have a massive impact on the JSE overall index, so you've got to bear that in mind as well. And then you can see that on the JSE overall index, we ended this downtrend with a little island, and then since then we've been moving up very strongly, and I expect that trend to continue. Just to give you an idea, this little upward trend here, in the first 3 days of this upward trend, Naspers and Richemont, just those two shares, added 100 billion rand to the JSE's market capitalization just in those 3 days. Of course, the S&P 500 reflects the US economy, so that is always something to keep in mind. At the moment, the US economy has got very, very low inflation, and in fact, I'm just showing you the S&P 500. You can see the previous high that it made over here, 2872. That was on the 26th of January. Then we had a 10% fall, and it found strong support at this level here, 2581. And since then it's been tracking upwards, made new record highs here. This high particularly at 2930, which occurred on the 20th of September. And since then it's been tracking down. It came off 9.5% altogether, but it does look like it's beginning to move up now again. And what you'll notice also on this chart, of course, is that the 300-day moving average, which I've got here, just kept on going up. So that would have kept you in the market and kept you believing that this was just a correction and therefore a buying opportunity. Of course, in the US, the inflation rate was 2.3% in September, and that's lower than the previous 2 months, which were 2.7 and 2.9% respectively. So inflation actually seems to be falling in America. And that information may slow the pace of interest rate hikes, which is an unusual situation because usually when you have a very tight labor market in America, that causes inflation because it causes wages to go up, and that tends to be inflationary. But in America at the moment, you've got ultra low unemployment, below 4%. And at the same time, you've got inflation falling. I don't expect that situation to last very long, but that's how it is right at the moment. The US Treasury bill, the 10-year Treasury bill, is trading on an interest rate of about 3%, and that should be compared to our R186, which is trading at 9.2%. So there's about a 6% gap between the US T-bill, the long bond in America, and the South African long bond. And that, of course, that gap exactly quantifies the risk which South Africa brings as opposed to America. So the increase in risk between South Africa and America is basically worth 6% on the long bond, the long government bond. At the moment, the risk-on sentiment in emerging markets is slowly improving. So we're moving back from risk-off to risk-on. The risk-off is when people move money out of emerging markets and into first world countries. That has happened because of the trouble in Argentina and Turkey and elsewhere. That type of problem is starting to dissipate, and we're seeing a move back from risk-off to risk-on. One of the best ways to evaluate the S&P 500 is to look at the quarterly results. Of course, in America, companies report every 3 months, not every 6 months like they do here in South Africa. Now, if we look at the September quarter, so ending on the 30th of September, 140 of the 500 companies listed on the S&P 500 or included in the S&P 500 have reported so far. 80% of those companies have beaten analysts' expectations. So that's very positive. The average profit increase is 22.5%. So profits are up 22.5% for those 140 companies from the same 140 companies last year. And that's off a 7.5% increase in sales. So this is quite a useful analysis, because you see, sooner or later, rising profits in these S&P 500 companies has to translate into a rising S&P 500 index, of course. If you want to see the progress of these S&P 500 companies, we have put the web address where you can go and see their results as they come out in the notes. So just go and take a look at that. Now let's turn our attention to the South African economy. Of course, the last month has been a hectic month. It began with Tito Mboweni taking over as Minister of Finance at a very delicate point. As we've pointed out, international sentiment was risk-off at the time. And we saw Mr. Nene resigning in a very gentlemanly and laudable fashion. And I have to wonder whether that will create some kind of new pattern in South Africa, where civil servants resign because they have done something wrong or because their position is untenable, and they realize that they're there for the country's benefit and not for their own benefit. Of course, the first thing Mr. Mboweni had to do was to produce a budget in October, and he obviously followed mostly what Nene had already prepared for him. But the budget, I thought, was, although it was a pretty tough budget, it introduced for me a new sense of maturity and realism. I see that they had some support there for SAA and SA Express, and also the Post Office and a few other of the state-owned enterprises. But I also note that Tito Mboweni has said that he thinks that SAA should be closed down or sold off. So that is a very significant step. No other finance minister has ever suggested that. As a result of that budget, the rand weakened temporarily to about 14 rand 55, and the long bond went up to 9.3%, but they've both recovered from those extremes. Cyril Ramaphosa has been doing his thing. He's held a job summit, which was summarized in an 80-page document with hundreds of projects, dozens of projects. It's a cooperation between business, labor, and government, and all three had to compromise to some extent. The goal is to generate 275,000 jobs per annum, which of course is easily measured and may become a rod for Ramaphosa's back as the election approaches. But the ANC should keep in mind the comment of Jim Rutherford, who's a non-executive director of Anglo American, where he said, "It is investment, not ideology, that creates jobs." And on that note, of course, we have to move on to Ramaphosa's investment conference, where we had 27 Fortune 500 companies from 25 different countries coming to South Africa to participate. Ramaphosa said that he managed to create or get commitments for 290 billion rands of investment, which was added to the 400 billion rand of investment commitments that he already has. Some of those commitments, of course, were already in the pipeline. In other words, big companies like Aspen, which committed 3.4 billion, or Discovery, which committed 13 billion, would have spent some of that money. Naspers also put up 4.5 billion. So that some of that money was already in their capex budget. The objective, Ramaphosa wants to reach $100 billion of foreign investment. A scorecard was developed, and we're almost halfway there with roughly $48 billion of committed investment. South Africa appears to have much greater credibility now with investors, overseas investors. There is a perception that it has turned the corner, or is turning the corner. The petrol price was very bad news in September because of the 25% jump in the oil price this year and the weak rand. Obviously, a hike in the petrol price by 1 rand will cause inflation to go up, and that will cause declining consumer spending. And this comes at a bad time for Ramaphosa, who's trying to get ready for the May 2019 election. But there was no petrol price hike this month, and it's quite probable that there will be a decrease in the petrol price next month. So possibly that will become a positive factor rather than a negative one. The National Planning Commission produced a report which was far more realistic than the previous one that they produced, because it's talking about 14% unemployment by 2030 and not 6%. 6% is just simply unrealistic, and nobody really believed it anyway. So realism is useful. It's positive. Even if that reality is stark, at least you're dealing with the truth and not some sort of pie in the sky. The trade account showed an 8.8 billion rand surplus in August, which was then followed by a 3 billion rand deficit in September. The trade account is very volatile, and it goes up and down, and it's very difficult to predict. But if South Africa runs surpluses on average over a lengthy period of time, it basically shows that the country is running at a profit. We are exporting more than we are importing. Of course, the weak rand helps with this because it makes our exports cheaper on world markets and imports into the country more expensive. So it tends to encourage trade surpluses. One notable factor is the motor exports, which made a record of 34,781 vehicles exported in September. And that's a pretty impressive record, and the motor industry is doing very well in this country. It's probably one of our economy's great success stories. You have to bear in mind when you're thinking about that Australia no longer makes any motor cars locally at all, probably because their labor is simply too expensive. The South African Reserve Bank follows the methods used by other reserve banks around the world, and particularly, of course, the US Federal Reserve Bank. They meet every 2 months. They look forward into the future 6 to 12 months ahead to see whether inflation is going to get out of control, and then they adjust interest rates to compensate for that before that inflation starts to occur. The difference is that the US economy is a very big economy, and so it's not really subject to external shocks. Whereas South Africa is a very small economy and is impacted all the time by external shocks, just like the oil price 25% rise this year. That is a major economic shock, which South Africa felt very, very directly. The official position, as far as the South African Reserve Bank is concerned, is that the inflation rate, that is the CPI, will rise to 5.9% in the second quarter of 2018, and then fall back of 2019, and then fall back to 5.4% later on in the year. But 5.9% is very close to the upper target of 6%. So any external event could actually tip us over that 6% level, and that would obviously cause rising interest rates. Consumer spending was up by 2.5% in August, very good. Economists were predicting only a 0.1% increase, and the third quarter. And that's good news for the third quarter GDP. Remember that consumer spending makes up 60% of GDP. Spending was obviously impacted by the fuel price increases and also the VAT increase. But we benefited from a relatively strong trade account where we had net inflows of cash. Our economy is slowly starting to benefit from the rebounding world economy, and particularly the American economy. Moody's, of course, took the decision to retain South Africa's investment grade, although they made some quite strenuous comments about the way things were going, and particularly the level of debt, the government debt in this country. All right, let's now talk a little bit about the Rand. And I think it's quite important that you keep your eye on the Rand if you're a private investor. Just let me find that. I seem to have got out of the range there. Where is it? There it is. Right. So the Rand is obviously very much affected by the switch in sentiment from risk off to risk on and back to risk off again. So here's the Rand, and I'm just going to go to a line chart, and I want to put 5 years on the screen so that you can see it. And there you can see this is the channel that we've been following for some time, which is a strengthening channel. Started when Nene was appointed over here. When Pravin Gordhan was appointed over here, and then strengthened all the way through this period. But recently it has weakened quite sharply and broken out of that channel. You can see this big formation here, which is outside the channel. And that is caused by the international move towards risk off. It's not really a great deal to do with what's happening in South Africa. And now that seems to be dissipating, I think we can expect the Rand to come back inside the channel. And I'm considering that it will come to about 13.50 Rand to the US dollar in the next few months. That's my expectation. So you need to take that into account when considering, for example, whether or not to buy a Rand hedge share. Of course, we've had a lot of reform inside South Africa, and we've got people now like Neil Froneman from Sibanye saying that Ramaphosa is a good ethical leader, and that he's got a very good relationship with the Minister of Mineral Affairs, that's Gwede Mantashe. So maybe those are the kind of things we want to read more of. Okay, now I just want to deal with a few general points, and then we can talk about individual companies. First of all, I noticed that the hemp market is taking off because they're now starting to include hemp in beer. There's a company called Poison City Brewing, which will be including hemp in beer from this month. In fact, you can already buy beer with hemp in it. Why is hemp important? Because it's obviously a component of cannabis or marijuana. It's not the HTC component, so it's not hallucinogenic, but obviously that adds something to the beer. And it's been noticed in countries where that has been made legal that beer sales tend to fall off where cannabis is made legal. So the beer companies are looking very closely at hemp, and maybe it represents a new industry that will have some kind of share listed on the JSE in due course. Now, I just like to mention the PIC. I don't know if you're aware that the Public Investment Corporation, which invests the funds of the government employees pension fund, and they have funds under management of 2.084 trillion rand. So 2,084 billion rand is what they are managing. It's under the care of a guy called Dan Machila, who's the CEO, quite a controversial figure. And they always keep about 100 billion in cash, so they're always ready to invest in new ventures. About 43% of the portfolio is in listed equities, 33% in bonds, and 5.3% in property. If you look at your ShareFriend program and you go to the company comment on any company, you'll see the PIC is generally one of the biggest, if not the biggest shareholder of most of the blue chip companies in South Africa. For example, the PIC is a 12.3% owner of Standard Bank and 15.16% owner of Bidvest. Okay, let's move on now. Sanral, they have said that they're not going to do any further development because they don't have any funds. The collection of e-tolls has been quite depressing, but they are becoming very aggressive in following up on people who owe money for e-tolls. Tito Mboweni has backed them up here and said that the users must pay. SANRAL has, however, written off about 6 billion rand as probably uncollectible. But I would expect that SANRAL will sooner or later start collecting e-tolls effectively, so it's something to bear in mind. In Zimbabwe, growth is expected to be 6.3% this year, according to the finance minister, who's a guy called Mthuli Nkubi, who was previously the head of business studies at Wits University. So he knows something about economics, and I think that his estimate may well be good. The problem is that Zimbabwe is suffering from a huge shortage of foreign currency. They don't have their own currency, so they rely on the US dollar and the rand. And they have a massive $17 billion national debt, which they are trying to restructure. I'd like to just now mention Bitcoin as well while we're doing this sort of general section. You may recall that a while back actually on the 8th of December 2017, we published an article on Bitcoin. Sorry, let me just get that graph a little better. Even 1 year would be good. Yes, we published the article about here. It was actually on the 8th of December, so it was maybe a little earlier there. On that day, when the Bitcoin price was $16,500 per coin, and in the article we suggested that this was a bubble and that it would burst. Since then, as you can see from the graph, the Bitcoin price has fallen quite significantly and has been moving sideways and downwards, and has now reached a level of about $6,500 per coin. We continue to think that this is a bad investment and potentially a bubble. A recent report by a security company called Cybertrace says that the theft in the Bitcoin market is up by 250% to $1 billion a year. So that's quite significant. We also know that organized crime uses cryptocurrencies to launder money on a regular basis. All right, and I'd like to just look at a few companies, just a few this month. I'd like to draw your attention to Anglo American, because Anglo has been doing very well. It's obviously a commodity share, so that makes it relatively risky. I'm just going to clean this chart up a little bit for you here. You can take the volume off, and I think we can put a bit more data on. No, it's not doing that. There we are. Now you can see here that Anglo bottomed out at the beginning of January 2016. And since then it's been moving up very, very strongly and very well. And that's because this is when the commodity prices turned and started to rise. So when I talk about commodity prices, obviously I'm including precious metals, but there's a lot of base metals and minerals in the commodity prices as well. Anglo would normally be considered a commodity stock and therefore highly risky, because its profitability depends on commodity prices which are set internationally in international markets and over which Anglo American has very little control. But with Anglo, that risk is mitigated somewhat because of its diversity of minerals. It's got a wide range of minerals that it mines and produces and markets, from diamonds to gold and platinum, of course, and then also base metals and minerals. So it's got iron and particularly copper, which is very strong at the moment, and those are compensating for losses in other minerals. So if you've got a diversity of minerals, if you're making a loss on one mineral, you'll be making a profit on the other. Another factor in Anglo is that it owns 85% of De Beers. The other 15% is owned by Debswana, which is a government operation in Botswana, and that enables them to some extent to be able to control the diamond price. And they have managed to do very well in the 8th site. They do 10 sites a year where they sell packets of diamonds to their leading retailers, and the 8th site was far better than expected. Also, I think Anglo American has become much better because one of the ways they've reduced risk is by cutting their debt. And in fact, under Kutifani, who's the CEO, they've actually managed to virtually eliminate debt from the company's balance sheet. So that puts them in an extremely strong position. The share has gone up 6-fold since this bottom point here in January 2016. So that's quite an achievement. And now there's very strong support which appears to have risen here at 280 Rand, and the share is trending up even further. If you're looking for a share which is more exciting than buying, say, one of the big banks or a real estate investment trust, then you might consider getting into Anglo American. The next share I want to look at is Clicks. Clicks produced results for the year to the 31st of August 2018. Their headline earnings per share were up 15.1%, off a rise in turnover of 9.1%. Now, what's interesting about this share is that it's actually been falling recently, as you can see here, and it reached quite a low point here. And now, since these results came out, it's been trending up very strongly. But what's interesting really about it is the long-term picture for Clicks. So now I'd like to put a long-term chart on the screen here, and then I want to go to a logarithmic scale type, semi-log scale type, just to show you that over the last 15 years, this share is what we call a diagonal. It's moved up basically from the bottom left-hand corner of your screen to the top right-hand corner. We call that share, that type of share, a diagonal because of the pattern that you get on your screen. And it's a very, very steady pattern for this company. It's been going up and up and up and up for years and years and years and years. And that period, remember, incorporates booms and busts. It incorporates all the years that Zuma was president and caused all the chaos in the economy. So this is a very recession-proof company indeed, and we really like it. Their club card membership is up 950,000 on last year, and that's a huge achievement. They will also be adding 40 new stores this year to the group. The CEO of a long time, David Neal, is resigning, but he's going to be replaced by the COO, who's a guy called, which stands for Chief Operations Officer, is a guy called Vikesh Ramsanda. And they have a very strong management team. So the share is trading on a PE of about 29, which is quite a demanding multiple, but we think it's well worth it. Now I'd like to talk about Astoria. Astoria is a small company which has a diverse portfolio of foreign shares which it owns. So it's quite an interesting little company, quite unusual on the JSE. And you can see here that it's trending up quite nicely. It owns shares in a whole bunch of interesting companies. It owns shares in Facebook, in Apple, Blackstone, MasterCard, Home Depot, overseas companies, foreign companies. It doesn't have more than 5% in any one of these companies, so it's well diversified. One of the interesting things about it is that there's a takeover bid for it by RAC. You may have heard of RAC, Rainbow African Capital, which already owns 30% of Astoria, but that takeover bid is being resisted by the board. In the third quarter, to the end of September this year, the net asset value is up 5% to $1.20 per share. We see this as a well-managed small company and also obviously a rand hedge, and therefore quite a good investment. That's our opinion. Lonmin, this is a very difficult company. It's a company which is the third largest producer of platinum group metals in the world. During the most recent quarter, it sold 681,000 ounces of platinum group metals at 14,512 Rand each. The price that it got was 25% higher than in the previous year, so it benefited from that. And a lot of that is due to the fall in the rand. They've just concluded a 3-year supply deal whereby they've raised $200 million from a company called Pangea Investments, which is a Chinese mining magnate company. They used that money to pay off their debt, which was $150 million, and then to put a further $50 million on the balance sheet. Sibanye is in the process of buying Lonmin for shares, in exchange for shares. There are a few legal impediments, but it looks more and more likely that that deal will go through. Lonmin recently announced the retrenchment of 12,600 staff members and the closing of 5 shafts. But we think that the share is making what we call a saucer bottom here. There you can see the saucer bottom. And we think it's probably going to rise off this base here. That's what we believe. Obviously, it's highly risky, and its fortunes will depend very much on what happens to the platinum price. Dis-Chem also produced results in the month just past. The results for the period to the 31st of August 2018. Headline earnings per share were up 10.5% off a 9.4% increase in turnover. This is a company which has significant blue sky potential in our view, and we believe that any price on this share, I don't know why I've got Discovery. I think I pressed the wrong key there. There we go. So we believe that that Dis-Chem has got a lot of upside potential, because everywhere there's a Click store, there can be a Dis-Chem store. Here you can see how it came down quite strongly into the high 20 rands, but since then it's moved up. We believe that any price around 30 rand is a good price for this share. And the company has also recently announced that they intend in the future to pay 50% of their profits out in dividends, which is quite motivating for shareholders. They're in the process of buying 2 other companies, Springbok Pharmacy and also a company called Quenets. And that shows that they are rapidly growing. They're expanding their footprint throughout South Africa. Then there's a company that I want to talk about here. It's called Into. On your share friend, you'll find it if you type ITU. So don't put in the N, ITU. That gives you Into. Into is a company that specializes in producing, in running shopping centers in London. Particularly in London. They have 17 of the best shopping centers are dotted around London, in the sort of greater London area, and then they've got 3 shopping centers in Spain. In the year to June the 30th, they had a 97% occupancy rate at the end of that year, and their rental income was up quite sharply, about 1.3%. They've completed the expansion of the Watford extension and also the Lakeside Leisure extension. And over the year, they get about 400 million visitors at their shopping centers. But the price has fallen dramatically. It fell from 190 rand to as low as about 28 rand, but it's now trading for somewhere around 35 rand, 36 rand. And remember that this company has got a net asset value of about 63 rand, so it's trading at almost half its net asset value. There's an offer by the Peel Group, who currently owns 27% of Into. They want to buy out the rest, and they're making a consortium to produce an offer. And that obviously is why the share price moved up quite strongly during the month. Finally, I'd just like to talk about Cartrack. Cartrack is a company that everybody should have in their portfolio, every private investor. They're in the vehicle recovery business. I'm sure you know about them. The share price is quite low. It's just down here at about just under 14 rand. This company, we believe, is cheap at this level. It's trading on a price earnings ratio of 12.5, which compares to the average for the JSE of 18. But they are expanding rapidly. In the 6 months to the 31st of August 2018, they produced results which showed their headline earnings per share up 25%, off a 27% increase in turnover. They have got interests all over the world. They've got operations in 24 countries, and they are expanding all over the world. They have very little working capital. Most of their income is annuity income, and they are growing at a hell of a rate. We believe that you should accumulate this share on weakness whenever you see it to be weak, and right now we believe it is weak, so we think that's a good one to put in your bottom drawer. Sooner or later the institutions are going to start buying this share, and when they do, I think you'll see it being re-rated quite significantly. Ladies and gentlemen, that's about all I have for you this month. So I wish you a good investing month, and I'll talk to you again in the first Wednesday in December. Thank you.